The Mayberry Investments Limited Virtual Investor Forum has been the standard for investor education in Jamaica for decades, where top financial minds provide comprehensive insight into the market and ideal investment strategies and opportunities for our clients. Celebrating 37 years of excellence in investment banking. The Mayberry Virtual Investor Forum, investing in Jamaica.
Good evening, ladies and gentlemen. Welcome to yet another episode of our weekly Investor Forum. I'm your host, Dan Theox, Senior Vice President of Investment Banking. Today, we'll be looking at Fesco Limited, and we'll be looking at their year-end results for 2023. Joining us this evening is none other than their Managing Director, a good friend of mine, Jeremy Barnes. Welcome, Jeremy.
Thanks for having me.
Our pleasure. And we'll also be joined online by our CEO, Gary Parrott. Welcome, Gary.
Hi, guys.
Great. Well, if you like the content, then don't forget to hit the like button and share this video. And if you haven't done so already, remember to subscribe and hit the bell to receive all future notifications. We upload content just like this just about once per week. Additionally, if it's going to be your first time making your investment journey, remember, patience wins the investment game, not speed. That means the earlier you start, the better. Why not take that first step with Mayberry Investments Limited? Follow us on social media today to get started. Guys, don't forget that we'll have a Q&A segment at the end of the program, so make sure to submit your questions early so we can address them at the end. Okay, first up, I'd like to do an introduction of Mr. Jeremy Barnes, who is the Managing Director of Future Energy Source Company Limited, called Fesco. Fesco is a leading transportation and fuel distribution company operating in Jamaica. Additionally, through its proprietary brands of Fesgas, Fesco is the third largest distributor of LPG by volume in Jamaica. Jeremy has led the firm through its initial IPO in April 2021 and its growth from 7 service stations in 2017 to 23 gas stations by June 2024, and its entry into the LPG industry only last year, April. Under his leadership, Fesco has grown its net profit and book value of the equity from $13.7 billion and $31.2 million respectively in 2017 to $515 million of net profit and $2.15 billion in equity as at March 2024. Jeremy is a senior executive with extensive experience in operations management, financial analysis, and financial management. He has over 25 years of experience in fuel trade, holding positions of dealer and managing director prior to his engagement at Fesco. He must have started at age 5. He holds a Master's of Business Administration from the Motor School of Business, UWI, and a Bachelor's of Business Administration and Finance from the Zicklin School of Business, Baruch College in New York City, USA, where he graduated summa cum laude, which means top of the class, guys, and was the recipient of the Irvin Fromm Academic Scholarship for International Finance. Jeremy is a former Chief Financial Officer and Chief Operating Officer of Marathon Insurance Brokers and Federal Capital Group Limited. Didn't know that. Give a big up to the CEO there,
Richard Berger.
Richard Berger, great friend of ours. Richard Berger, hurry up, Richard. We're waiting on you for the IPO. Okay, well, guys, that's it. So as I said before, Jeremy is a very good family friend. I've known him for many years. I don't think he's been in the fuel business for 25 years unless he started at age 10.
Longer.
I think of myself as being your older brother, and I'm 52. So, Jeremy, you must have gotten going really, really, really early. Okay, so what we're going to do, folks, is Jeremy will have a presentation for us. Then I'll come back and do my little financial analysis, and then we'll jump into some Q&As within the room, within the studio, and then we'll kick it out to Q&As to you guys online. So once again, guys, online, I encourage to send your questions, and we'll be happy to address them closer to the end of the program. So Jeremy, over to you.
All right. Again, welcome everybody. Thanks for having me again, Mayberry. I really appreciate it. I'm going to take you through the unaudited results for the full year ended March 2024. Next slide. All right, again, this little advertisement that, we want to really promote that we're now into the cooking gas business and we're in it at all levels from retail, that cylinders at your home, to also commercial. So we do deliver to your restaurants, your hotels, your bakeries. So, you can just reach out to us. We're very familiar with that space now and we're happy to take you on as customers and serve you. Again, what does Fesco do? Our products. Initially, we started out in distributing petroleum products, which is mainly around transportation fuels. But now we're in all the transportation fuels. We also do blends. In addition to that, we do supply asphalt and bitumen, kerosene, and heavy fuel oil to industries. We also do now LPG, which through our Fesgas brand. That's the next big thing for us. And within the petroleum space, we also provide petroleum equipment. So if you have a light industry or manufacturing and you need your own supply of diesel or fuel, we'll come in, we'll put in storage facilities for you and also dispensing equipment. And we employ a lot of technology to that space. So the customers that do come to us do realize that there are some attendant what we call operating inefficiencies that we, and that's an important feature that we do offer to that space. We do also sell lubricants and coolants. That includes our own line of Futural oil, Future Lube lubricants, and now we're doing Castrol. We're the distributor for motor engine oil for Castrol in Jamaica. In addition to that, we have our own FYC drinking water, which we do distribute through our service station convenience stores, which is very actually popular. It's very delicious, if I do say so myself. From listing, sorry, next slide. From listing, we had about 14 stations. Up to today being June, we're at 23. We recently added Fesco Hayes, that's in Clarendon, but as at the year end March, it was 22 stations. During the year, we added Port Maria, we added Kitson Town, and we added Maypen. So we grew by 3 during that year. But it was towards the latter part of the year with the first one coming in Maypen around July. Kitson Town was around September, and Port Maria was around December. Market share. There is, next slide, please. Market share. So at that 2021, we're about 4.4%. We have steadily increased our market share, and it's around transportation fuels. So now we estimate that we're about 9.7% of market. Again, these numbers aren't necessarily up to date. The ministry numbers aren't up to date, but we do apply what you would call it a growth rate to what the last numbers that were available for the industry. And that growth rate is, typical across this industry, this mature industry. And it also reflects, the numbers actually reflect significant growth over last year. So over last year, we won't disclose what the exact numbers are, but we've grown our throughput about 16% from last year.
And this makes you the largest local owned.
Correct. So we're the largest local distributor of transportation fuels by both locations and by volume.
Okay, congratulations. So you've overtaken Petco.
I'm not sure what the names are of those companies.
Yes. You're the largest.
I'm not quite sure. I've heard of them, but I just can't recall the names at this point in time.
Not a problem.
Right, but yes. But during that time, so in 2021, we're basically a fuel distribution business, which at IPO we told you we're going to go into the retail space by opening and operating Fesco Beachwood. So since 2021, we have now gone into service station management and operation. So we don't just operate Beachwood Avenue, we also operate 2 other locations, which is Kitson Town and Hayes. We're not the owners of those stations, we are tenants of those stations, but we have increased our retail presence and our retail margins accordingly. In addition to that, last year we did tell you that we're going to go into the LPG space. And in going to the LPG space, you're not just knowing distribution, you're actually in manufacturing. As the headings, next slide. Right. So as the heading says, our expanding operations will include distribution, manufacturing, and retail. So, being part of the LPG space, now we're breaking bulk. We're taking bulk LPG and we're breaking it down into cylinders. So we're actually, packaging and distributing LPG to retail households, either directly or indirectly through dealers or directly to customers' homes. So we're a big now in the retail space on both LPG and also in gasoline, because we're now operating service stations, not just distributing to dealer-owned, dealer-operated service stations. So in addition to that, part of that process is we actually own some of the manufacturing. So we have two of the LPG filling plants. They're located at Bernard Lodge and in Nago's Head, St. Catherine. We've also commissioned two new sites, one in Discovery Bay and one in Stony Hill. So, our footprint of LPG plants as at today is about 4. We just finished commissioning those. And that distribution, goes through to dealers, some of those filling plants are distributed to dealers and also to customers directly. So that's a distribution path for that business. In addition to that, we also distribute, as I said, fuel, which are our traditional business. We distribute fuel, technology and equipment, chemicals, etc., to manufacturers, to our service stations, and to our filling plants, etc. Next slide. What does that mean for the overall of the company? So for March 2021, as I said, we're in fuel distribution and we did chemical and water distribution. So you'll see our gross profits were about $194 million then, which went through to net profit, pretty seamlessly. About half of it went through to net profit. And our EBITDA, there was not much difference between our EBITDA operating profit and our operating EBITDA and our net profit. As we go down, through the years, we added different activities. So if it's from March 2022, we added Beechwood Avenue at around November that year. In addition to that, we had new service stations and our growth of our distribution business to other service stations. So you saw a growth in gross profits, again, operating profit and EBITDA. And there's not much difference again between operating profit, EBITDA, and net profit, because it was capital light. It didn't take a lot of capex to execute those businesses. As we press forward to 2023, again, we're making investments in LPG, but we didn't start the business yet. So there was no necessarily interest expense or any depreciation. Come to 2024, so we're up, last year, 2023, we're up to about $887 million in gross profit, which is, significantly different from 194, which was, just 2 years prior. And, our net profit spiked at $571 million for the year, with EBITDA just being $595 million and operating profit about $569 million. This year, I'm thankful, to the board, the team members, management, everybody out there were able to get into not just the LPGs, but expand the business overall significantly with additional locations operating, and also, as I said, the cooking gas business. So what you saw during this year was a substantial increase in gross profits. Again, we're in different parts of the business. We're not just longer in retail from the service station or distribution. We're now also into manufacturing. So it's a different cost profile. Now we operate many locations. There's a lot of security involved. There is capex. There is insurance costs. Insurance now is about between 1 and 1.25% of the assets of the company. Mm-hmm. So all those impact, and then also to get into the LPG space and to also expand our gas network, we executed 2 bonds, one for $1 billion and one for $700 million, and then that has an interest cost applicable to it, and then buying all the assets that are associated with the LPG space impacts on the depreciation cost for the year. And again, getting into a new business, getting the customers aware, we have to spend on advertising. So what you saw in the numbers for this year, a significant expansion in gross profits, about almost $1.5 billion. Operating profit is now $672 million, and now you're seeing the difference between operating profit, EBITDA, and net profit. Right. And one of the key numbers for us right now is EBITDA, because it tells you how much cash you are generating on a profit basis, operating. That's a key number for us because we have to pay our debts, and we also have to, in addition to that, we have to grow our business, because we do see, we're a small company. We started very small. I mean, we're just about 10 years plus. Yeah. We've been growing every year. We do see there's room to grow. So EBITDA is a key number for us. But, that really explains why the numbers are what they are. They're pretty good and excellent numbers from what we, from our standpoint. And it does reflect the changing nature of our business, that we're going more retail and we're going into manufacturing. So the cost profile of the company will change and has changed. It also reflects, next slide, please. It also reflects that when you start a new business, revenues don't start day one.
Right.
So we did going to LPG last year, but sales and everything didn't pick up from day one. So there's a gradual increase during the year, and we're actually very, very pleased as to where we are now in LPG. In addition to that, the additional stations that we added through the year didn't come on April 1.
Right. Filling stations, this is.
Not filling and service stations.
And the service
So the service stations in Kidston came on in September. Maypen came on in July, and Hayes is just coming on, right?
Got it.
So what you will see is that there are some costs that are associated with those businesses that you just started to get revenue, not for the full financial year.
Right.
So going forward, you'll have 12 months of earnings to put with 12 months of those costs. So for this upcoming year, you'll see an annualized LPG business, you'll see an annualized Dodo operations, DOCO operations, dealer-owned company operated in Kidston and Hayes. So this is just a summary again from what we published a few weeks ago, where we're very pleased at the growth of our profitability numbers, especially gross profit, operating profit, and EBITDA, which all grew substantially. EBITDA grew by 42.3%, and shareholders' equity, which increased by about 65% for the year. That's a combination of two things. Obviously, there's a retained earnings of 515 million, plus we did buy some properties which were due for valuations, and there has been an increase in property prices generally across the market. So there's about 318 million, I believe, thereabout, increase 230 million thereabout. That was a result of a revaluation of some of the assets that we do have. That does not pass through the P&L in our case because we're not in that business, but it goes straight to PP&E and it goes to the shareholders' equity. So that gain is not reflected in our profits. If that was, it would be made 800 million. That's not how they account for that in our business. Again, what the key goals for us for this year or the year just gone past was to establish the Fresh Gas brand. So we had to increase our advertising spend substantially. We wanted to increase our network footprint and our fuel sales. As I said before, increase our fuel sales year over year about 16%. Increase our profitability, especially raise the EBIT and operating cash flow, because those are the numbers we can control. And again, the timing of, when you match revenues with the cost. And in starting a business, we do understand that we had to ramp up. And unfortunately, net profit fell about 10%. But again, it's significant for the year, being over $500 million, especially coming from about 108 million at IPO just 3 years ago.
Absolutely.
So the key points were interest expense jumped about 165 million. Depreciation was up about 137 million. And advertising expense increased about 31 million for the year. Next slide, please. Again, this takes you through the details of all the numbers. This is in our Q4 report. The key numbers here are, we just explained already, which were EBITDA, operating profit, and net profit. And there was increases in, as I said, advertising, depreciation, and interest expense. Next slide, please. To take you through our expense profile, again, you have to look at our expense profile in the sense that the company is growing. So you can't just look year over year. You see some, whopping increases, let's say, in staff or, but you have to look at what the business is. So last year, talking 2023, March and 2023, we had about 68 employees. And in March this year, we have 130 odd.
100% increase.
100% increase. So if you look at staff expenses have grown a lot. But in relation to gross profit, staff costs are just less than 19% of your gross profits. Previous year was 13. There's an increase there because, again, the nature and the profile of the business is changing.
Right.
We're now into manufacturing and more retail. So, there's an increase in staff expenses, accordingly. If you look close at the numbers, you also see depreciation is up significantly from 28 million last year to about 164 million this year. And I said advertising was about 16 million the previous year, now up to about $47 million. Again, we have to spend a lot on advertising to get the brand awareness out there. We do have our trucks, if you see them out there branded, which, plus we did some, events like food awards and our online presence. So we had to spend a lot on advertising to get our brand out there. Again, we think we're running pretty efficiently where our overall expenses are about 54% of our gross profits. And our total expenses, excluding depreciation, are just about 42% of gross profits. So again, it's translating a lot to the bottom line, even within the context of a capex and entering new businesses. Again, for our business, the development process of a gas station takes about 2 to 3 years. It's not, it's not 6 months. It's not within a financial year. If we do open a gas station, or plan to open a gas station next year around September, which is Fesco Oval, our own station, that's been in the pipeline for years, right? And we do have a pipeline now of, many stations, and we have to keep a pipeline open because, again, it takes 2 to 3 years to develop a station. On the LPG side, next slide, please. On the LPG side, it also takes a long time. So if you want to expand, you have to have cylinders. And cylinders manufacturing process about 3 months. And then shipping is about another 2 months. So, any growth that you're doing, you have to time it. And you have to ensure that there's a lag between when you spend money and also when you actually have the assets to deploy. So for April to June, that's subsequent to the year end, we opened Fesco A's. We started construction on Fesco Oval, and that's scheduled to open about September next year. We continue to acquire and deploy LPG assets across the country, from cylinders to storage tanks. And as I said before, we added 2 new filling plants. We continue our development of Dodo service station. It's not something I can speak to directly now, because again, it's various stages of the development process, and we don't really make announcements until we do get the requisite approvals. We don't interfere in the process. And we continue to expand our LPG distribution. We have a lot of LPG assets, especially on the commercial side, to deploy. And we continue to make a social contribution. So, we took on sponsoring. We do sponsor children's homes. So, we gave some beds to 2 children's homes during the year. We also, do with Heart Foundation. We did some stuff there. We do sponsor a lot of football tournaments across the island in the area. So to develop youth football. And next slide. This is really the next thing that's coming, which is Fesco Oval next year. Again, Fesco tries to develop properties and service stations that Jamaicans feel proudly Jamaican and proud about. We want a lot of people visit our service station, especially Fesco Ferry, Fesco Beachwood, Bodles, just to name a few, the one in Port Maria, Ocho Rios. When they visit these sites, they take family, to be honest, and they take pictures. We have a lot of people coming to our sites at Beachwood Avenue shooting music videos. And in the nights, it's just somewhere we like to build a place that Jamaicans can feel proud about, and proud that it's a Jamaican that they executed this. So we continue to do this, and we want to build another exciting destination station at Fesco Oval.
Which is going to be on Spanish Town.
On Spanish Town Road. And that's it. Thank you.
Very good. Thanks. We appreciate that, Jeremy. Gives us a little color into the business, because I tend to just be into the numbers only. So it's good to appreciate what you guys are doing, and we'll definitely have a couple of questions in relation to same. So as usual, folks, I just want to focus a little bit on the numbers, mostly the key statistics, because Jeremy did such a good job on the numbers. So guys, if we can bring up our slide, we get to that first page as usual. So again, I won't need to spend too much time talking about the profitability of the business. A couple of highlights I do want to make. For sure, it's good to see you guys getting up to $28 billion in revenues. That's just amazing. I do note the gross profit, the final net profit margins are tight. Net profit margin down to 1.8%, coming from roughly 2.2% the year before. So I want to talk a little bit about that. I understand wholeheartedly the decline in profitability by 10%. It's primarily because you've taken on $1 billion of debt to expand the business, incurred this $160 million in expenses, interest costs, but we didn't see the full year operations coming out of the new businesses that you did, whether it be the gas stations you added along the year or the LPG rollout you did across the year. When I make those adjustments, there are a few things that I think are notable. One, the business is generating $840 million of EBITDA. And if you go into the cash flow, you'll see it literally threw off $1 billion worth of cash for the year. So that's definitely a positive. Business has $1.93 billion worth of debt relative to $849 million of EBITDA. So from a debt to EBITDA perspective, very low leverage, 2.3 times. And we're comfortable seeing companies having leverage up to 3.5 times, folks. So 2.3 times debt to EBITDA is not a concern, very lowly leveraged. Another way we could look at that is their interest cover as well too. So
Correct.
EBITDA divided by interest, 5.5 times interest cover. Again, most debt covenants are happy seeing 2.5 times coverage. So you have twice the normal level of coverage. It means the business has the capacity to take on more debt to expand in the future if needed. And then overall cost of borrowing is about 8.1% as well too, folks, all in. So all in cost of borrowing is $1 billion profit on $2 billion of equity. We can see that the ROE is 40%, substantial. So it makes good sense for you to use leverage responsibly to grow the profitability of the business. And so, kudos to you guys. We look forward to the next year when we see a full year
A
of
full year.
profitability rolling out. I want to talk a little about the increase in expenses because I think there's some one-off costs, and we'll talk about that. If you could give us a feel for the level of one-off costs, that might also help us reset our minds as to the reduction, the likely reduction in costs going forward. On the key statistics, folks, again, stock is trading at $3.16. So if you got this thing at IPO, you'd be up over 200%, in 2.5 years. So that's great return. The PE is 15 times, which is about reasonable for the junior market. Junior market average is 15 to 16 times. Why I think Fesco is relatively cheap is because of the level of growth that we're seeing. So I'm not used to seeing companies that are growing its revenues as materially as Fesco is and showing the potential to continue growing those revenues. So I think it should be cheap at $3.16. I really think it's a good buy. And I think we're going to see substantial increase in profitability going forward. If they can get their gross profit margin up to 2.25%, even at this level of sales, guys, this would be a $650 million business, and then that PE would be 10 times, and you would appreciate that it's really, really cheap. So I'm going to predict in the next coming year, we're going to see profitability getting up to the $650 million space, and you'll be sorry if you didn't buy the stock now at $3.13, because in a year's time, when interest rates have come down, PEs are going to go back up to 16, 18 times, and this will be a $4 stock easily, like super easy. So I think it's a good buy from that perspective. And that's pretty much the only thing I'll focus on today. Other than that, the share price, just to look at how it's traded over the last 2 years. I mean, this stock is traded at a high of $5.10, just to let you know, guys. So again, from just the technical perspective, you can see the curve. It's been trading down. I think people may not be fully understanding what's happening at Fesco. In the stock market in general, though, Jeremy, we've seen
Yes,
a lot
yeah,
of stocks
correct.
pulling back. So I look at this curve and I really think it's not going to get any lower. It's a great time to buy this stock. I really do think this stock is going to jump by 30 to 40% in the next 12 months. And so from my perspective, it's a good buy. And that's it for me in terms of my analysis of the numbers. I think I've covered all of the main points I wanted to cover. It's a great business. It's asset rich, $3.3 billion in assets. So for those of you who are looking to buy solid businesses where the barriers to entry are pretty high, this is one of them. This is not a fly-by-night. It's not a upstart. It's not a fintech where the barriers to entry sometimes can be low. It doesn't require a lot of capex. It's a fairly capital-intensive business. It's a combination of over 40 years of experience. And Jeremy, I do want to pause a second to speak to certainly the four stalwarts that come to my mind now. Your dad who recently passed, Trevor Barnes, Hugh Core, Errol McGraw, and Trevor Heaven. These gentlemen collectively have been in this business for over 100 years. And so it's great to see four Jamaican businessmen in this space come together, do this kind of IPO, present this type of opportunity so that the average Jamaican can be a part owner in this business. And then this is just, I've said it before, the perfect IPO business, which you can come back and look at it 2.5 years and see that the stock price is up 250%, the profitability is up 350%, and the business is still showing that it's poised for great growth. There's much more growth to come. So if you didn't get it at IPO at $1, I got it at 183. Perhaps I flipped too early at 450. I'm going to definitely think about buying some more. It's a great stock to have into your medium to long term portfolio, and you guys have done a really good job with the branding. I mean, I personally get my 93 fuel at the Fesco in Prairie when I'm heading out to the country. I love it. It's perfect. I try to get there with my tank empty, full up, and then I go to the country and come back and have lots of fun with it. So I really like the brand. I like the gas. There's nothing wrong with the gas. I've heard some crazy rumors. I love the gas. I have a high performance car that would not perform if that gas was not good. So it's great gas. And I do put it in my runabout car as well too. So love the fuel, love the company. There are not many opportunities like this, guys, on the stock market to be in this space with such a powerful brand, leading in the space as a locally owned business. And it's great to see you guys now getting into the LPG space. So my first question for you, Jeremy, is it's not apparently obvious to me how the LPG business complements the gas station business. It sounds like it's similar. You get it from Petcom or Petrojam or whatever, but it's fundamentally a very different business in the sense that it's very capital intensive and the distribution channels to get to your customers are very different. So just tell me a little bit about your thought process, you guys' thought process for getting into the LPG space, and what are your ambitions exactly in terms of, whether percentage of sales or market share or market position. How should we think about your ambitions to get into the LPG business, and why LPG for Fesco?
Okay, so LPG is part of the energy space, and we're an energy company. As we said, our name is actually Fesco, means Future Energy Source Company, right? So for us, we thought it was a long-term business. People have been electricity has been in Jamaica for a long time. One of the first countries in this side of the hemisphere to have electricity, but people still cook with gas. It's more efficient to the energy conversion to heat. People cook with gas. They love to cook with gas. We believe it's a 50, 100-year business, so we want to get into it. Yes, for piped gas to homes.
Right.
So for every customer, the company has to have or create or lend to that customer storage facilities, which is a cylinder. So it's very capital intensive. If you want to get to 600,000 homes, you have to have probably close to 1 million cylinders, one for the customer and one to replace the one at its home. So it's very capital intensive. Another side of the business, which is accurate, which is different from the gasoline business, is that the distribution from a gas station is location specific. Somebody comes there, whereas LPG, you take up the phone and you call and somebody delivers it to your home. So the location of the transaction is different.
Right.
So it's a different distribution business, different. It gets into manufacturing, separate, different from the gasoline business. There's some similarities regarding haulage. You still have haulage contractors. You do have the same suppliers, etc. So there's some, scale or economies of scale that you do get from, being in both businesses. But again, the business have, some things that are significantly different. We do see that business is generally a higher margin business because you have to participate at different levels. So you have to participate in this CapEx, which is storage.
Yep.
You have to participate in manufacturing, and you have to participate in distribution and retail. So the cost profile is different, which necessitates a higher margin profile. If you want to talk about market share and targets, my board would kill me if I divulge too much at this point.
But what's your ambition in general? Are you going to play more in this space? I mean, you put about $1 billion into that space.
We put a lot of money into that space. Suffice it to say, what I can say is that we're the the third in a very quick time.
In 1 year.
In
that's
1
impressive.
year, yeah. So we've garnered significant market share. To be honest, I can't go into any details. I'll get murdered by the board. But we're participating very well in that space, and there's a lot of growth potential in that space. There's a lot of barriers to entry. So it's a very it's one of those business that we believe that it's a body corporate that can compete in this space.
Right.
The amount of capex that's required and the series of injections of capital is not necessarily for an individual to operate in this space. So I do believe there are significant barriers to entry for this type of business. There has been some consolidation and in that space, also and margin contraction as a result of our entry and others entering the space. We do understand and know that it's also a challenging business because you do have some incumbents there that, are sizable and regional. So, it does come with the challenges, but I think, at Fesco, we're not really shy away from, challenges. We embrace them. We do believe that we have a strong brand. We do believe that if you employ that's the way how we do stuff. We look at the numbers significantly, we look at the opportunities, and we do believe that there's space to grow in that space. I will not talk about market share specifically. I won't talk about, we won't go into divisional reporting. Again, we would, but even our regional company, they don't really go into too much about what they do. On a country by country basis, they talk in general and they don't speak to market share. But we're very pleased that we're able to capture so much market share in such a short time. That also requires us to actually invest in getting new assets to deploy. Let's put it that way.
Very good.
We have to add to our capex to fully execute what we want to do.
Mr. Parrott, we haven't forgotten you, sir. I'm sure you have one or two questions for Jeremy. What say you, Gary Parrott?
Sure. Thanks, Jeremy. Great job so far. The question with these types of businesses, you have competitors coming on daily. But I like to move into cooking gas. That creates a new avenue for growth. But I think, as you pointed out, you need the capital for the bottles. Within a year or two, where would you get that growth from? Because you're starting to see, even in your gas numbers, that the rate of growth is not growing obviously as how you started. You're going to get some nice growth out of the cooking gas side.
Mm-hmm.
But how do you maintain growth rate going forward?
Excellent question. Again, I spoke to our pipeline of gas station development. So, the gas station development path for us is not just Fesco Oval. We have quite a few stations in the pipeline. I think there was a Gleaner article recently where we did communicate that within the next 5 years, we should be up to about 40 stations. Within the next 24 months, we should be adding, at least another 4 stations to be conservative. So there's growth on the gas station side. If you're talking about on the LPG side, we enter the market mostly on the retail side, but there is room on the commercial side of LPG. We'll be focusing on both the commercial and the retail side. So if you're asking from a question of growth, we do believe that there's significant amount of opportunities still for us. If you look at the number of counter service stations, we are about 23 now. One of the larger competitors has 80. Another one has in the 70s. One has in the 50s. That's number of stations.
Yeah.
We don't believe we'll be getting to 80. That's not our strategy.
Yeah, but my question is, I mean, everybody is growing to 50, 80, whatever the number is. But I don't think each of these stations that you put on will be as successful as out at Mandela. But the reality is that as you add them and you fill in the network, wouldn't you start to see declining rates of growth? Because you're going into, the market, the overall market is growing at a particular rate.
Correct.
And the question is, as you put on additional gas stations, yes, you will get additional revenue, but you get to a point where you have critical mass.
Correct. And the truth is we're not there yet for our business. Again, there's a lot of locations that we're not present in. A lot of markets we're not present in. I think at IPO we expressed that we weren't in the Kingston and St. Andrew area. And to address Kingston and St. Andrew, we were just at Beechwood Avenue. We're rural in Stony Hill, rural in Rock Hall, and we're exiting Kingston at Ferry. So there's, if you look at Kingston and St. Andrew by itself, we're totally
Right.
outnumbered. If you look at, we're not in St. Thomas, we're not in Portland at all with any presence. We're in Montego Bay with one location. We're in Mandeville or Manchester with one location. So we don't see our growth being cannibalistic to our volumes.
Okay.
So we do believe that, as we grow at this stage of our growth journeys, it won't be cannibalistic regarding margins or offtakes. And we don't need every station to be as successful as Ferry. We're very proud of Ferry. And
You
other
wouldn't mind,
stations. That would be absolutely amazing. But not to take away from Ferry, but we do have also other stations. I won't go into the numbers, but our stations that we have put on in the last few, iterations of stations are producing very well. Actually, for the most part, stations tend to do better than we actually thought they were going to do. Again, we appreciate the customers and the patrons for that, because what we have found is that there's a strong affinity to the brand. And again, I think it's part of what we try to do by building locations that people can feel proud and safe to go. We're well lit, we're bright. Women feel comfortable at our stations. We have security, both plain clothes and in uniform. So our patrons feel safe going to our location.
And Jeremy, I have to say I'm impressed with the service. And I've been to Beechwood at 7:30 p.m. at night and seen a good volume there. I mean, you get through quickly. It's 7-8 minute wait line. But at 7 p.m., so I know you don't need to say it, that Beechwood location has done exceptionally well. So tell me, with the addition of 3 new service stations, how has that increased how do you think that has increased your fuel sales in general and your overall market presence? I believe you hinted at 16% growth in volumes.
Correct, year over year.
9% growth in dollars. How have the 3 new stations sort of helped impact that 16% growth vis-a-vis just, growth in the existing stations themselves?
Okay, good question. Again, I'll be non-specific, but giving a good answer, which is those stations came on in the latter part of the year.
Okay.
So Maypen came on in July, as I said before. Kidston came on in around September, and Port Maria came on in December. So that 16 is about 16.4% growth. Is not just attributable to the new stations.
Got it.
It's also, and again, that's 3 stations out of what you'd call
23.
Right. So it's not that. It's our existing business actually growing. So what we found is that again, there's a affinity with the brand that the customers have come out and supported us, not just at these new locations, but all the locations. So I guess that answers that question.
I think so.
Yeah.
Expenses. So, saw $130 million increase in other expenses, substantial increase in operating expenses. Generally, we, have a good understanding for the depreciation, the staff costs. Could you give us a feel for the level of one-off costs that you might have had that might not necessarily repeat itself in the future? Is it 20 million? Is it 50 million? Just to give a rough feel for the type of one-off expenses, startup expenses that might not likely repeat itself in the following year.
Well, you do have a lot of what you'd call it, developmental costs.
Yeah.
From research to planning,
Yeah.
fees, etc. Those are one-off, but for the next few years, we're still again having a lot of development mode.
Right.
So those costs won't disappear. On the other expenses side, we do have, as I said, insurance is a significant cost. Security is a significant cost. I believe we spent last year about 40 million on security alone.
And that increase, that would have jumped with the rate increases.
It's going to jump again, because I think even the minimum wage, changes earlier this year. So our security costs have increased with the number of locations we operate.
Right.
And again, we like our customers to feel comfortable at locations, and so we do have a security presence at locations. Our business also, as I said, as we go more retail, the POS charges will increase, and as customers tend to want to use their cards more and more, those costs increase. And again, as I said, insurance cost is another substantial cost, new cost to the business, because of all these assets that we do have.
Right. Good deal. All right. So, folks, wow, A lot of questions coming in. So, Gary, I'm going to give you one more question, and then I want to take about 4 or 5 from social media because I got about 13 in the queue. So, Gary, over to you.
Have you thought about acquisition as opposed to building out other gas station? I mean, you have a lot of other smaller players. I mean, is that more efficient?
For the most part, gas stations are typically owned by the marketing companies, the larger, the multinationals. So they own those locations, so they're not necessarily ready available for sale. To answer your question more directly, yes, we have thought about it. Where it's something that we would pursue if the opportunity presents itself. That Yes, the question is yes. The answer to that is yes. It's something that we would pursue if the opportunity presents itself.
Okay, very good. So let's take a few questions. I suspect some of them, some of them we've answered already, and I know some you won't answer. So, in the LPG space, I'm just gonna ask it because Limitless Podcast is asking, how does Fesgas plan to deal? How does Fesgas plan to compete with Massey in the LPG space?
We are competing right now. We do have we're competing right now. We're competing on the retail and very, very well. Actually very well. Massey has a strong company, and they've been around. They have acquired IGL, so it is formidable competition. But to be honest, we don't look at don't look at our environment in that way in a competitive light. Like I'm taking share. That's not how we actually look and do our business. We honestly believe that anything that's going to move the needle in our business materially takes 3 years. So looking at what somebody does now is not really that important. What we really look at, what we think Jamaica will be in 3 years. So developing a gas station is not what's there now,
Yeah.
It's what we think will be there 3 years from now. And the same way in the LPG space. Again, that business is even a longer tail business. It's what we think will be in a few years. I think it's not taken from Amazon. When I heard Jeff Bezos say they operate 5 years in advance. They leave the operational people to do the operating stuff. But what management is really thinking of is business in 5 years' time. That's where we are at Fesco. We didn't take it from Amazon. It's just how the nature of our business. Anything that's material going to move the needle is going to move the needle 2-3 years hence. So even when I'm talking to you now, the numbers are kind of old. And I know what the numbers will be for the next year and for the next year coming, because we do have to plan the business that way. So the direct question is, do we look at our competitors? We look at them for information, but not for guidance.
Good deal. I appreciate that. And again, what you've achieved in 1 year is impressive because you're going up against like really formidable folks in that LPG space. We just discussed one of them in the form of Massey. You've got Petcom in the form of Carjon. So they're big players out there. So for you to have achieved what you've achieved in only 1 year, when I would have thought that LPG customers are sticky. And so if you get in there and you do a good job, I think if you can get them to switch, which obviously you've gotten them to do in 1 year, and then you do a good job and provide good service, I think they will stay with you. And folks, I do want to sort of reiterate the point that Jeremy said, just from an energy perspective, gas stoves are far more efficient than electric stoves. You will reduce your energy costs by 40 to 50% by using LPG. I made that switch about 5 years ago. 2 things you want to do in your home if you're trying to reduce your energy bill. For starters, switch to LPG. And secondly, if you use hot water, switch to a solar hot water heater. If you do those 2 things, you usually reduce your energy cost by like 40%. So it's a good strategic move on your part to offer a solution to residential retail customers who are trying to reduce their energy costs. And LPG is a far more efficient way to heat your food than to use an electric stove. Okay, Philip Burgess says, congratulations on the rapid and robust growth. It appears that one of your branded stations in Withern has changed to another brand. Was this strategic for Fesco, or was it owner driven?
We're not commenting on that
On
at
Withern.
the
Okay.
moment.
Okay, well, you achieved your 16% growth in volumes despite that. I appreciate that. Ryan Purcell asks, with all the planned expansion you currently have, are you actively working on raising more equity capital, he says.
We're constrained by the junior market. We raised 400 million at the first IPO. There's been announcements for the increase of the cap to go to 750. We believe that when those regulations are published and from the opportunities there, yes, we do.
You would take a look at that.
Yeah.
Good deal. All right, sounds good. Tavares Donaldson, I need to read this before I can see if it's it's appropriate. I'm sorry, Tavares. I don't understand what you're saying. I'm going to say it aloud for the benefit of the customers, but I don't think it's something we'll respond to. In a year's time, the insiders will still be selling. Not too sure what he's saying there. Diplomat of the area, are the plans to venture into renewable energies? So are there any plans, I think he's saying, to venture into renewable energies, solar or wind farms?
Our name is Future Energy Source Company. So we're always, again, as I said before, we're looking years in advance. At this present moment, we don't see the ROI, but it's something that is not actually on the table.
Good deal. And then Brandon Thomas asked a question Gary asked about, are you looking at not organic growth, but sort of acquiring businesses instead? And so Jeremy said, yep, that's definitely on the table. Damoy Skeen asks, how are you planning to protect your existing market share against competition, and what unique advantage do you believe the company currently possesses?
Okay. Without going into too much detail, for what we've continually said is that we do build destinations. So you find people come to our stations, like yourself.
Yeah.
You come to Ferry, to get a product that is not widely available elsewhere, which is, we call it 90 plus, which is a 93 octane minimum, which is not widely available, and we do offer blends. So on a product standpoint, we do offer products that others don't. We do offer a variety of services that others necessarily don't. So when you come to some of our stations, they have a supermarket there in Old Harbour. You go to many of our stations, from Rock Hall to Old Harbour to Mandeville to Ferry. Many of them, Stony Hill, have money transfer services. So you can get your remittances there. We have the convenience stores. We have restaurants at Fesco. We're going to have a QSR restaurant to drive through. We also have that at Angels and Ferry. And in Port Maria, you also have Chinese restaurants there. If you go to Ocho Rios, you will see there's a bird shack there. So, our stations offer far more than just a fueling solution for our customer. And we believe that the mix of location, the aesthetics, the services, definitely being a destination station gives us an advantage, or makes our product attractive to the motoring public. And we salute and commend all our dealers out there for developing these stations. Again, it's mostly dealer owned. We do help and participate in our development process, but we do commend our dealers out there for following us on this journey. Yeah.
Good deal. And the Fesco Oval, as you said again, will be company owned, company operated.
Company owned,
I like the sound of that.
Yeah.
We need to try to see if we can get a bird shack there. Shout out to Wayne Cummings from Bird Shack. We're looking for big and great things from Bird Shack. Okay, let me pause for a second to talk about our giveaway announcement. Thanks a lot, guys. As we promised, we'll just announce the winners courtesy of Fesco. And I always struggle with these names. I'm going to do my best. Congratulations to at NickKip2031, at Good Gal Kareen. Honey, it's up on the screen. I'm just reading it. Good Gal Kareen. I don't know her personally. To at Clark Faith Tashali. Our team will be reaching out to you guys via social media platforms so you can collect your prizes. Congratulations, guys. So, Gary, in case you have one more question, I'm going to wrap up in 2 more minutes. I like the stock, Gary. I think it's cheap at 316 and a 15 times PE. What are your thoughts on it?
I mean, really and truly, this stock should be trading at its growth rate.
Yeah.
And so, the team at Fesco has been finding innovative ways. Well, not innovative, but ways in which to drive growth. One of the things that I liked about the business, I remember when he spoke about creating new blends of gas, where you can actually create higher margins relative to other blends in the marketplace. I didn't ask him about that earlier. But as I said, the cooking gas is a significant market. He can eat market share there. He's coming in, so everybody is going to have to see a reduction to what he's doing. Also on the gas station side, I mean, he hasn't been in Kingston, but yes, you can get locations in Kingston. But even if it's a smaller margin location, it's still accretive to his business. So, I think based on their growth rate, the PE that they're trading at probably should be a little bit higher on that basis. Yeah, it's not a bad stock to hold.
I appreciate that. So we both concur. And with that, folks, I think we'll bring today's discussion to an end. I'd like to thank our viewers for tuning in. Your support is always appreciated. And big up to my brethren, Jeremy. Thanks so much, Jeremy, for coming on the program and sharing your insights and your views. We greatly appreciate it. Still don't believe you've been doing this for 25 years, but I'm kidding, folks. I know he has it. Just teasing how good he looks for a man of my age. I'd like to thank Gary for his invaluable contributions as usual. And to our viewers, be sure to look out for future updates on our virtual investor forum. Remember to follow us on social media, where we share all things forum related on our official social media pages.
Last word.
Say it again?
That's the last word.
Yeah, please, man.
Please visit our mother's location at Fesco Beach Road. Just recently opened. So
our mother's location.
Yeah, so you can come there and get your breakfast, your soups, your patties, your chicken. The chicken is lovely.
Okay, big up to Kevin Donaldson and the team handling that as well too. So more synergies, more finance guys getting into space. I like it, Jeremy. I will try to pause next time and get some chicken patties or something when I get there next. In fact, I'm probably heading there now because I need to fill up my car with some gas. Well, folks, that's it. Don't forget to subscribe to our YouTube channel, Mayberry Investments Limited. And remember, wise investors, slow and steady wins the race. Keep safe, everybody. Goodbye.
The Mayberry Investments Limited Virtual Investor Forum has been the standard for investor education in Jamaica for decades, where top financial minds provide comprehensive insight into the market and ideal investment strategies and opportunities for our clients. Celebrating 37 years of excellence in investment banking. The Mayberry Virtual Investor Forum